Hi everyone, I'm going to give you a little bit of education around how the markets move. And then once I've given you that education, I'm going to show you that applied to Bitcoin right now. Okay, so if I were to ask you the question, how does a market move? Every single one of you should tell me that it moves in zigs and zags. Okay, because we know that's how they move. Yet for whatever reason, when you buy something, you think it should do this. Even though we all know market zig and zag. And every time we get a zag, you panic and you panic. Okay, so we know they zig and zag. So we need to know, okay, where are we? Because sometimes you don't know if you're in this zag, that zag, or if you're in a bigger one. Okay, and that's where it's really important to know what phase you're in, where you could be, so you know if it's going to be a larger correction or just a minor correction. So knowing that the market zigs and zags, how it works is you have what's called Dow theory. Okay. He was the grandfather of TA. People like Elliott Wave, Wyckoff, all these kind of things, they have all based their work off Dow. Okay. And what he discovered was that the market moves in three phases. You have what's called an accumulation phase, which is when the retail aren't aware of it and big money's starting to buy it up. It's normally they call it the stealth phase as well. We have the public participation phase, which, as the name suggests, the public start to get involved. And then you have the excess phase, which is your euphoria phase, where everyone's universally bullish and we are going to the moon, baby, pretty much. Okay. Distribution phase, people don't know that they're probably still bullish. And then that's the big money getting out. Then the public start to get a bit bearish, and then the panic. And just goes over and over and over again. Okay, so let me show you that within here. So what you have is you have your first wave, which is the accumulation phase. Then you get from that one, when it starts to pull back, you get what's called a 1/3 to 2/3 retracement. Okay, so what happens is that often it'll come down to this kind of pocket zone here, which is the 382 to 618 zone. That is where we're often looking for prices to bounce off down here. And then it moves into the public participation phase. You can tell the public don't really get involved until you take out the high, because anywhere here, it could roll over and do another one of them. People still aren't convinced yet. Okay, it's not until you take out the high that they're like, oh, okay, we're good. That's when the public begins here. Okay, so we're going up, public. Then we get another pullback. Now, this pullback is getting a 1/3, 2/3 retracement from here. Okay, again, this is all stuff from Dow. He said that for every push, you'll get a 1/3, 2/3 retracement. So then what you're expecting is the same thing, for it to come back down and buyers step in here. And then we go up into the excess phase. All right, so this is the part where we need to know, because as I showed you from before, we only have the three phases. So hang on, what comes after that? So what comes after that, after the excess phase, and this is human emotions coming out, because humans don't know it's happened the first time. The savvy ones clue on the second time. Third time, everyone can recognize a pattern. Okay, so then from there, what you're looking for is going off knowing how the zigs and zags work. What you're looking for on this final wave is buyers should step in that 382 to 618 zone here. If they don't, and they come below the 618, this is what Dow said as well, if it happens on increase in volume, then it might not be a zag, it might actually be the beginning of something else, a larger bear market. On top of that, you'll notice that, hang on, why haven't the sellers become buyers there as well? So you got a couple of things telling you that something could be up. You know, people that like their trend lines as well, you'd have a trend line going up there. All of a sudden, we're breaking the trend. Resistance isn't becoming support. We're breaking through our normal zag zone. Something's up. So if we fell through that 9,000, alarm bells would start to ring. So what actually happens after that is if we do fall through that 9,000, what you get is what's called a zigzag of the whole thing. So now what we get is actually a 1/3, 2/3 retracement of the whole thing. Okay, we go to the 382,618 zone here, and this is actually where you would expect the buyers to step in, somewhere around there. Then what happens is that whole thing happens again. So now we've had that move, and now we go up again. 1, 2, 3, 4, 5. Then we get a 1/3, 2/3 retracement. Buyers step in here. Then it happens again, and we go up again. 1, 2, 3, 4, 5. What you'll notice though is all of a sudden you're like, well, hang on the bigger scale, now I have the accumulation phase here, the public participation phase here, and the excess phase here. So what do you think happens after that? You get a 1/3, 2/3 correction of the whole thing now. Okay, so now going up to the top, you could expect it to come down to here. And then it just goes on and on and on and on. This is why you always talk about the waves are fractals of bigger waves, kind of like a piece of broccoli. You pull one off and there's other little bits within it, and over and over and over again. Okay, so let me show you this whole process in our Australian 200 market, so you know it actually works. Okay, so here you can see that we had our beginning phase here. Okay, you can see the 3 phases. 1, 2, 3. After that, we get a 1/3, 2/3 correction. Okay, you can see it came down to the 382. So we had our 3 phases, 1/3, 2/3 correction. Then we move into the next spot. So again, we have our 3 phases. Then we get a 1/3, 2/3 correction. Then we move into our excess phase, and you know it's excess phase because it goes really rapid and really quick. Okay, so remember after that, what happens? We get a 1/3, 2/3 retracement of the whole thing. And look at that, 200 stocks all happen to bounce off the 618 at the same time. Okay, so now we've completed one. So now we move on to the next one. Same thing again. Okay, you can see accumulation phase, public participation phase, excess phase. What happens after that? We get a 1/3, 2/3 correction. Oh, look at that. We bounced off the fib 302,618 zone again. It's magic. Okay, zig, zag, zig, zag. Now let's do it again. Same thing again here. Accumulation phase, public participation phase, excess phase. And after that, what do we get? We get a 1/3 to 2/3 correction. Magic again, bouncing off the 618. Okay, and then you'll notice along each one of these ones, they all were bouncing off 1/3 to 2/3 along the way. Okay, zig, zag, down to the 382,618. Zig, zag, down to the 382,618. And then the final one, remember, corrects all of them. Okay, even this recent one, when we went up, zig, zag to the 382. Okay, so knowing that's how the market works, it zig, zag, zig, zag, zig, and then correct all of it. That's what we have to unpack now. So let's do that on Bitcoin. Okay. Let's go down to the daily. What I can see here is accumulation phase. Again, think about sentiment during that time. Everyone thought it was still bearish. Public participation phase. When we took out the high, the public started to get involved. Excess phase. Okay, possible final move. So possibly what could be happening now is if we do get a change of structure on the daily is that we could actually be getting a 1/3 to 2/3 correction from the top here, which would be a healthy pullback, a zig to zag, anywhere in this 52 to 41 kind of K zone. On top of that, if you now then let's look at this final excess phase to see if that's possibly finished as well. Okay, so looking at this. Okay, so we're going to unpack that funnel wave. Within the funnel wave, you can see accumulation phase where people would have thought it's going to roll over after the ETF. Bearish sentiment. Public participation, we took out the high. Everyone starts getting involved again. Excess phase, you probably saw it all over social media, really, really bullish. So even from that, you can see the different phases as well. So let's now then unpack this final wave and see if we can see 5 within that one as well. So the final wave, same thing. You can see accumulation phase, public participation phase, excess phase. Okay, so right now, all we're getting is a typical healthy retracement that it's supposed to do after it is down to that zone. However, if we break through the 57.5, which you can also see aligns with that resistance zone, I would start to question why. Why is this not just a normal zag? Okay, because then I'd be like, oh, okay, maybe we're not just retracing this one. Maybe we're actually retracing this whole one. 1, 2, 3, 4, 5. So then I'm like, oh, okay, so if we go through there, maybe we are actually correcting from here. Okay, because again, you can see accumulation, public, excess. So a healthy correction would be to come down to anywhere here. Again, if you look at the key zones there, the 618 aligns with this kind of zone. So hang on, if we start to come down here and we break through that kind of 48K, which was the big FIB 618 level, that was the ETF drop, those kind of things. If all of a sudden buyers aren't stepping in there again, something's up. Okay, so that could still be, so at the moment, we might just be retracing this move. If we break through, we might be retracing this move. If we break through 50K, then we might actually be retracing from here, from the 25K, which means that you would be looking for life anywhere in there. If buyers did not step in that 42K zone range there, that was the major buying point where people bought after the ETF sell-off, and we've gone into euphoria. If all of a sudden they're not buying there again, something major has changed. Okay? So at the moment, we could just be getting a little pullback on that one. If we break through, we could be getting a pullback from that one. Okay, so that one. If we pull back even more, we could be getting a pullback from that one. We don't know what zag we're in yet. Or if it's even a zag, it might actually be completely done and you come all the way down. You don't know. We don't know if it's the beginning of a zig or a zag yet. Okay, all we can do is take it one step at a time. But this is why I personally said yesterday in the YouTube video, be careful. We're very overextended. The weekly's overextended. We are due for a pullback. I could see we were moving into the excess phase of the excess phase. You're seeing the sentiment all over the media. Doesn't mean we still can't push a bit more, but the chances are there's more chance of it actually correcting here than there is of it to still keep going. So it's whenever you buy or hold an asset, it's always about risk to reward. Okay. The risk is actually greater than the reward right now at a major resistance, seeing these kind of things. On top of that, what you'll often get as well is on these final excess moves as well, they will happen on lower in volume. So if I show you the volume, you can see that we have gone up in price, but we have gone down in volume. Okay, volume is not matching this move right now as well. Okay, so then that's another little sign that, oh, this could be the excess phase as well. Volume often doesn't match the final move as it's moving up. So some definitely warning signs. I just wanted to show you how the markets move. Okay, once you understand the movement, you kind of understand where it's at and you understand when the risk to reward is actually greater. Okay. Where you always want to buy is you want to buy at the beginning of the public participation phase. Super easy. Look at this. Microsoft. On the weekly. Bring it right back. Okay. Tech bubble, corrected, accumulation zone. Then, what have we done? We've changed market structure. On the first, higher high, higher low, higher high. Okay. First phase. Then what happens? You get the public participation phase. Then you get the excess phase. After that, what do you get? A 1/3, 2/3 correction. If you think it doesn't happen, it does. Trust me. Let me show you an example. Woodside Energy, the #1 oil stock in Australia. Accumulation phase, public participation phase, excess phase. Okay. There was not a person on the street that was bearish on oil during this period before the GFC. The thing had been ballistic. However, if you bought and invested, I'm putting that in, you can't see it, bunny ears quotation, during that period, you are still holding your bags 10, 15 years later. Okay, because we had completed the phase and now we have a 1/3, 2/3 correction. Okay, this one actually went lower, 786, even deeper. Okay, so just be careful when you're in these excess phases, because it's healthy to get, as you can see, that first initial drop for the GFC bounced off the 618. Okay, it's typical to have a 1/3, 2/3 trend. Sometimes they go deeper, sometimes they go shallower, but it's around, I think it's 80% of the time they fall into this 3026. It's called the golden pocket zone. Okay, so you know where I'm at. You know why I've said be careful with your leverage. Spot buying, all good. We haven't got to change the structure. Okay, you just sit back, relax until you get to change the structure. But leverage plays, you never want to be holding strong leverage when you're in that potential excess phase euphoria and you know that it could pull back. Hope that helps, guys. Hope you loved the video. If you liked it, please like and subscribe and spread the word. Take care, everyone.